Excellent.
All right, let's go ahead and get started.
Attendees, welcome to our second series in the wealth journey. My name is Derek Laurie. I am the president of the Federal Credit Union. We have a number of committee members here.
You cut out after committee members.
Each introduce themselves before we identify.
He's cutting in.
Okay, let me start. My name's Charles Bruce. I'm a member of the Fraternity Credit Union Board and have been working with this group assembled here to present this webinar series. Thanks for all of you for joining. Let me move on to Curtis Baylor.
Good evening. I too am a member of the Credit Union Board, and I welcome all of you. And I also put in my plug, soak in what you get tonight and be ready for next week.
Excellent. Davina.
Yep. Good evening, everyone. My name is Davina Ware, marketing consultant for the Credit Union, also a member of Delta Sigma Theta Sorority Incorporated.
Davina, it appears that I am going through audio challenges. I'm going here into another way, but
Okay. Yep, because you're cutting in and out. So we will just keep it rolling. So sorry about that. Our president is traveling and his audio is cutting in and out, but nonetheless, we'll go ahead and get started. So today is the second part of our three-part series about your journey to wealth. So we had a really great session last week talking about home ownership. So if you're on the mailing list, you should have received the recording, but that will also be on the website, which is below at www.opppffcu.com. And if you don't know what that acronym stands for, that is the Omega Psi Phi Fraternity Federal Credit Union. So without further ado, I will be your slide advancer here. If you have questions, you can go ahead and enter them into the chat. Let me just defer to our speaker. Constance, would you prefer to wait till the end to answer questions? We have found that to be most successful.
Okay, that'll be fine.
Okay, guys. So what you could do, there's a chat option. There's also a Q&A option. So as you think of questions, as we're going through the content, feel free to add them there. And about the last 15 minutes or so of the presentation, we'll make sure that Constance is aware of those questions so that she can answer them for you. So let's go ahead and dig in. So just a little bit about the credit union. We've been around since 1986. That's literally as long as I have been alive. So we have been through different seasons, but have a lot of good information, a lot of great products and services, which I'll share in just a minute. All the members of the fraternity are eligible to apply for membership, as well as their family members and all members of the Divine Nine. We also are known for providing life membership loans. So if that's something you're interested in, definitely let us know. And contrary to popular belief, as to recently, we are the first of the Divine Nine organizations to have a credit union. So a little bit about our products and services and what we're currently offering. So we have checking accounts, savings accounts, money market accounts. We have some loan options. We just finished a really great auto loan promotion. I think it was at the end of May, where we have pretty much the lowest rates in the country. There's debt consolidation, that life membership that I was just mentioning. And there's some also great financial support. So if you need a little bit of coaching or direction or reporting and things like that, we can help you with that with tools and calculators. So as you can see, this lovely lady that we have on our screen here is Ms. Constance Stewart, and she has been a financial advisor with Prudential since 2013. She is most proud of hearing from her clients about how her team helped to improve their life. So she's very passionate about debunking some things and helping you climb out of holes or pits that maybe you made a mistake and got yourself in a financial area in a mess, but she's going to teach us how to climb out today. And she is also a member of Delta Sigma Theta Sorority Incorporated, Glen Ellen Alumni Chapter in Glen Ellen, Illinois. So without further ado, Constance, I will give you the floor.
Well, thank you so much, Davina. Look, can you advance to the agenda for the night?
I sure can.
Okay, look at this agenda. It says, what do you do when you're overwhelmed with bills? Understanding your FICO score and its effect on your loan approval. The process of getting control of your debt. So that's a lot of good information that I think it will help you out and help you get out of debt and help you build wealth. Next slide, please. He says, buried in bills. Are you there? Are you headed there? What can you do? Oh, it says digging out of the hole. Oh my goodness. Have everybody felt like they're in a hole? You know, it's like, what can I do? It says I'm painting. This is how you get yourself in a hole. And a lot of times we don't think about that. We start getting credit too fast. You know, when you first get out of college, at least I remember when I first got out of college, you get all these credit cards in the mail, you know, and you feeling all excited because now you feel like you're a real adult now. Well, sometimes we get it too fast. Then we start using these credit cards. And then we start getting things that we want and not things that we need. You know, we go into Best Buy. We see the biggest TV on the wall. We're like, okay, I got a job. I can get this. Oh, it's on sale for $17.50. It was originally $2,000. Guess what? You really didn't save $250. Now you're $17.50 in the hole. Put in the chat and raise your hand. Are any of you guys impulse buyers? You know, I used to be an impulse buyer, but my saving soul is my sister. Just before I get ready to buy something, I'll give her a call and like, hello. She's like, what are you getting ready to do? And she'll kind of talk me down. But there are a lot of impulse buyers out there. I know in the chat room or the chat with reaction, everybody should have been raising their hand because I'm sure at one point in our life we did buy something impulsively. And then that's when you start maxing out your credit card because we want to get what we want and not what we need. We want to go out and get the shiniest new car out there, not even looking at the used car or even looking at can we afford it. Small amounts, guess what? They add up very, very quickly. And then you get those things said, well, you know what? You can buy this and pay it in 24 months. Well, you know what they're hoping that you'll do? When 24 months get here, you don't have the money to pay for it. Now you have all the accrued interest. Now you bombarded from all directions. And don't go on social media and shop for something because every time you open up, they got this ad up there. They got this ad up there. It's like they know your whole shopping history now. Next slide, Ms. Davina. Hello. Now, so we're slowly filling that hole. We're digging ourselves in there. Your monthly payments on credit start to increase. Your ability to save for a rainy day becomes less and less. Your emergency fund, it goes away. You begin to justify, but you know, it's only $20 a month, or they say I don't have to pay for 24 months. So then when you start paying all these bills, $20 here, $20 there. Now it's time to pay for my deferment. You don't even have money left for your expenses of gas, utilities, food. So now what do? You go use another credit card and you start using that to take care of your normal expenses. Then you find out, okay, now I did that. I paid all my bills. I don't even have any money to eat. What do you do then? And what's really bad, especially in the African-American culture, we go to those payday loans. They are such a ripoff because you never get out of them. You're paying here to the next day. They know you get a check, so then they keep adding that interest. So now we're slowly filling that hole more and more and more. Slide, please. Now, oh my goodness, you are like the dirt is on top of you. You are buried. You get behind on your payments because all these are $20 here, $20 there, deferred payment. Now you start getting bill collectors. They mailing you, they're calling you. You're looking at your phone like, okay, is that a scammer? And you know, these bill collectors are really, really, really cheap. What do you call it? Fancy now. They're called, hello, Constance, how are you today? And you're like, who is this? We're calling because this is a national debt collector. We let you know that you're on the recorded line. Okay. Then you say, I'm going to go to the store because I really need to get me a little food. You go in there, you put your card in there, guess what? It's declined. Then you have a car or you have a home. Something breaks down. You have no credit card. How do you fix it? Get a letter. Now, first you started off, you know how they start giving you credit cards. You get a little secure card with $750 and it goes higher and higher. And then your credit gets up to maybe $2,000 that they say that you're credit worthy. But then when you start missing your bills, boom, they cut your credit off. So now you no longer have credit. So now you're wondering, how am I going to survive? So you said, well, maybe if I try to consolidate all my bills, maybe that can help me and I'll just have one payment. Well, sometimes you get declined for it, or sometimes they approve it. But what happens is sometimes that interest rate is so high, you still can't afford to pay the bill. Okay. Now we're gonna look at this little case study. Isn't that a nice, handsome young man? He just got out of school, math teacher. I love math. He's a new teacher. You know, teachers don't make that much, but they feel like they can make it. So he started off his $35,000 a year. He has limited credit because he just got out of college. So he got one of those secure credit cards where you put $750 in the bank and they let you charge so you can build up your credit. So your monthly payment on that is like $20 a month. This is where we start adding up and getting into the hole. So then your parents, they're trying to help you out because we're always trying to help our children. We let them use our authorized user on our card, $9,000. So that helps with your building your credit. And then you got a $70,000 in student loan deferment. Whew, boy. Now your rent is $650, so you know you're probably sharing that with someone because you can't find too many places for $650 a month. Then you decide, okay, I got me a job. I'm a real adult now. I'm going to go buy me a new car. So you'll get a nice little car, $28,000, 7.5% interest rate for 78 months. Boy, that's a long time. That's what it's like. What, 7 years? I mean, before, when I first got my first car, it was like 36 months. Now we up to 78 months for a monthly payment. And they say it's only going to cost you $455 a month. Okay, you take that and multiply it by that many months. Look at all the money that you're paying in interest. So let's look at this scenario. All right, so we're talking about our debt to income ratio. So with your $35,000 that you're earning, your gross income per month is like $29,717. That's before taxes now. That's not what you're bringing home. Now remember, your rent was $650. You got your little credit card bill of $20. You got your car loan. And so now, so far, your expenses for just those alone are $1,125 a month. You take that and you divide it by your gross. That means you have 39% gross debt to income ratio. That's pretty high. But remember, that $29,717 is not your take home. So now we're going to look at actually what is our take home? Well, when they take taxes out, your take home is $2,100 a month. So now we want to say $2,100. We're going to take that $2,100. That's going to be our divider there. So we take what our expenses are, and then we divide it with our net. Look at that, 54% debt to income. Oh my goodness. In other words, after paying bills, you got about $975 for the rest of the month. That means you got to pay your utility bill. You know you got a cell bill. You know you got cable, grocery, gas, insurance, etc. How in the world can you save anything? What happens when your student loans come out of deferment? You know they're coming out now. Although I did see today that the Biden did pay off some student loans, so hopefully that'll help us out too. Continue on with our study. Now, some of the recommendations is maybe we can find a less expensive car. Maybe we can try to look at our credit cards and see, because sometimes you can negotiate and we can find credit cards that maybe have a lower interest rate. Then we don't have to have the most fanciest phone in the world and the most sophisticated phone plan. Maybe we just have one where we call. Then, you know how that cable bill is. Everybody's been trying to cut the cable. Maybe we just find us a very inexpensive streaming service. Then maybe we can find something else where we can kind of cut down and say that these are things we need and not what we want. And so after going through all that, maybe now we might have an extra $300 that we can use to transfer to some of that. Maybe we might be able to put some of that into savings, and then some of that to help to pay for the expenses that we had before. So we need to go back into our expenses and see what do we actually need versus what do we want. Because do we have to have the latest iPhone or Android phone? Do we have to have the latest and greatest cable? So we need to really tweak that, because we need to find out how we get ourselves out of this hole. So now you see that dirt over there? We're shoveling out, guys. We're shoveling out. So some of the pros, they say sometimes you can do debt consolidation. Okay, sometimes it can lower your bills, that you can put it all into one pile and have one monthly payment. The thing about that, you want to make sure your credit is good enough so that you can get a good interest rate, because you don't want to have the interest rate is just so high that guess what, you still can't pay the bill. Then the cons are putting a Band-Aid on a nice wound, because we can get our debt consolidation, and like I said, the interest rate can be so high, we still can't afford it. And so are we just prolonging the inevitable where we might have to do bankruptcy? Hopefully we're not, but we got to find a way to shovel out of this hole. Now, does any of you guys have a budget? Raise your hand. Everybody should have a budget, because a budget lets you know where you are and where you're going. It gives you a roadmap. This is budgeting 2.0. Write down everything you spend, and even including a cup of coffee. I used to go to Starbucks, and I love to get me a caramel macchiato. But that, when I started looking at that, that was almost like $7 a day that I was spending on coffee. So 7 times 7, that's $49 a week just for a cup of coffee. Well, I could go buy me a can of coffee or some coffee beans and save. Well, we want to write down everything that you're doing. Better yet, they said there are different programs out there. You can use Quicken, you can use Mint, you can use Excel. And then it says you will soon see that the way you spend too much on pizza. How many people eat out? I just went today and bought some barbecue. You know, it cost me $10 or $12. I probably could have cooked something, but you know, we just have to stay within our budget, because you want to put in your budget what you can spend out, what you can't spend out, and what is your disposable income. Now, did you know that everyone can get a credit report? You can get a free credit report at least once a year. So you always need to keep track of what your credit is looking like. Because sometimes, believe it or not, even with the technology, those reports can be wrong. So you go in every year around the same time, request a credit report just to find out where you are, so you know where you're going when you're shoveling out. Other considerations, you need to know, like we talked about when you had your net income, we talked about the debt to income ratio. You need to know where you are. Your monthly payment divided by your gross, we showed that. Then we had the monthly payments divided by your net. And when you have a 40% of net debt to income ratio, means different things for different people, because it all depends on how much money you're making. Now, suppose you're making $25,000 a year net. Now, this is a net. So your debt to income of 40%, you have approximately $1,250 net income per month for essential expenses. That's when you're making $25,000. Now, when your income goes up a little bit more, you have $50,000. So now when you do your debt to ratio, you got now $2,500 of essential expenses. So the debt to income ratio is going to be different for each person, because it's not something for the mass, it's how much each person makes. But the most important thing is to watch your unsecured amount. That means those credit cards. You don't want your monthly unsecured debt to be greater than 10%. Because a lot of times when they're doing your credit score, they say that they don't want you to go over 30% of what they give you for your credit. Because then they feel like that you're using that credit card to live off of versus just using it for, incidental things. So that makes your credit score then go down. It says, example, $1,000 total outstanding unsecured balances divided by 36%. So that means that you're using 3%, which is not bad. It says unsecured debt is the #1 indicator of bankruptcy. It is important that you address your unsecured debt first. So you definitely want to keep track of that credit card, because when you go over 30% of using your credit card, they feel like you're a liability. It says, what makes a good credit score? How many people check their credit score once a year? I do. I always want to know where I am, because I want my credit score to get as high as possible, because I want to start using that money to build more wealth. It says important positive. What makes a good credit score? Because all credit is not bad credit. You look at some good credit is when you have a mortgage loan, installment, credit card, minimal inquiries. Because every time you go out there and get an inquiry for a credit card, it's a hit on your credit score. Or sometimes when you shop around for cars, it can be a hit on your credit score. So you want to minimize those inquiries. And what's the negative? Late payments. Anytime you're 31 days past due, it hits your credit report. If they look and see you only got limited credit, it hits your credit report. And please don't have collections, judgment, tax liens, all that. Bankruptcies, they stay on your credit report for 7 years. Then they see that you got a limit on your credit card of $3,000 and up to $2,900, maxed out credit card. Then you're trying to get more and more credit, large amount of inquiries. All these help or hurt your credit scores. Scores an effect on loan approval. The better credit you have, the better loan you can get. I want to have your scenario. One of my best friends, she was going to get ready to get a home, high expense home, over $500,000. She has excellent credit. When we went to college, she had $1,000. When we came out of college, she had $1,000. So when she got ready to get her home, she had just got married. Her husband was new in the field. They went to see, her credit score was maybe in the 800s. Her husband wasn't quite as high as hers. So she had to make a decision, the two of them. Can I just go on my credit score, or should I go on both of them? Well, if they went on both of them, they would pay $1,000 more. If they went on her credit, that's $1,000 they saved in their pocket. So credit score is the main thing that really runs the life today. When I first got out of college, credit wasn't that important, but credit drives everything now. It drives with your loan, when you're trying to go buy a home. It drives when you want to go buy a car. Even when you go get car insurance, everything is driven by your credit, because they want to find out, are you worth me risking credit on you? If your loan is approved, your interest rate is based on your credit score. So if you want to go get a car that's $30,000, your credit score is 600. Your interest rate might be 10%. But you can still get that same car loan, and your credit score is like over 740, which they call good credit. Your interest rate might be 3%. So that's a big difference. Look at the difference in those percentages. That's 7% now that you can take and save and start building some wealth. This is just showing you your FICO scores. Now you see down there 300. I know no one has a 300, but a lot of times they said that we're over into maybe the 670. But when you get past that 740, they feel like you're good. It says the average credit score in America, it said it goes from your lowest to your highest. They said Minnesota had the highest average, about 724. And these just tell you some of the states that have different credit ratings and what your different scores are. So it's very important to see your credit score. Where are you? What is your credit worthiness? This lets you know if you should purchase that house or not, if you should purchase that car. Maybe you need to wait till your credit gets higher before you try to go out and get a new car loan. Or maybe you need to wait a bit longer for your home because you want to build that credit up. So always make sure you check your credit score and be aware of what you're spending. It says the benefits of good credit. Well, lower interest rate on credit cards and loans. a better chance for credit card and loan approval, more negotiating power. Because I was gonna go get a car and I was at a couple of car dealerships. And I said, okay, so what is your interest rate? Well, it all depends on your credit. I said, well, I think that I'm in the good credit rating. So I want to know what is the lowest interest rate that I can get based on excellent credit. So they looked at me. You know, sometimes I think they think that we can't have good credit. And so I don't think he actually believes me. So I said, well, I want you to just price my car out with the lowest credit rating, interest rate. So, you know, he was hesitant, but he did what I asked him. So, of course, when I went to get the car, I was in that excellent credit rating, so I got a better rating. Saying that is, I could have paid probably $200 or $300 more a month. They're already extending these out to 78 months, which is, oh my goodness, that's a lot of interest that you're paying. So why would I try to pay more when I can do it for better just by having better credit? So you're going to get easy approval. Do you know we even go for a rental now? They check your credit. And depending on your credit, depends on how much security deposit you have to put down. Now, what about car insurance? All the car insurance companies, Allstate, State Farm, what's those other ones on the TV show? I can't think. God, what's the lady with the Progressive? They all look at your credit, and you get a better insurance rate. They might give you regular insurance, but if your credit is bad, they call a substandard insurance, which means it's going to be higher and the coverage is going to be less, but you're going to be paying for more. Even when you go in there and get your cell phone, you might want that newest phone out. They check your credit. Credit bad, the rate goes up on the phone. Credit good, sometimes you don't even have to pay a deposit. They just give you a phone. So these are all the good ways that good credit can work for you. And because this is a credit union, they know all these things too. They're going to ask you this. They're going to look at your credit worthiness. Should I extend a loan to them? Should I extend a payment for them? Should I give them a better interest rate? And I think Davina said when you had something going on with the car loans that you gave the best loans out, but you weren't giving them to people with bad credit. I guarantee you that. You looked at the people that had like 740 scores or higher. They were able to get the better rating from your credit union because everything is credit driven. It is so important when you first get out of college or even when you're in a Generation X, just before even the baby boomers, you must make sure that you concentrate on building credit because you don't want to give away money. Because if you save $200 a month, do you know what you can do? You can create wealth. You can start building legacy. You can start doing generational wealth. And we can start investing more. But if we don't have anything to save or anything to invest, how can we create wealth? They said the wealth gap for African Americans is much wider than any other culture out there. I don't know why, because we're the biggest consumers. We are the biggest spenders. But we must concentrate on our credit. We must understand that a 600 credit score out here is not going to give you the best rate. It's not going to allow you to save like you could. So when you start getting these credit cards, you want to say, do I want it or do I need it? It's good to have a credit card, but it's good if you charge something to be able to pay it off before the end of the month so you don't have to pay that interest on it. So use their money versus them using your money. And please do not get payday loans because the benefit of good credit sets you apart from a lot of people in the world. So make sure when you're investing and you want to build wealth that you understand your credit is one of the most important things that you can have to start creating wealth. Now, the D-Free Challenge, with the D-Free Challenge, they said that they have 3 Ds. You have your bad Ds and your good Ds. And what we want to do is take those bad Ds, which is deficiencies, debt, and delinquencies. We want to turn those bad Ds into good Ds. And the good Ds are we want to start having deposits, we want to start having dividends, and we want to have deeds. We want to start getting some real estate. So you want to change those bad deeds to good deeds. List your debts in the order from the smallest to the largest. Then we want to start attacking that debt and pay as much as you can So when you pay down one debt, you can use that money to pay down another debt. And you want to keep doing this until you get that debt to income ratio low. And then that would allow you to take that extra money and start building wealth. When you pay off your debt, you improve your credit worthiness, you reduce stress, and you create additional income for savings and investments. We want to be wise. Know your credit, including your credit score. We talked about that. Understand your debt to income ratio and how it affects your ability to secure future credit. Determine your wants over your needs. That is the best thing there. Don't buy everything you want, but concentrate on your needs. And once you are able to save more, you can buy some of those wants. Avoid impulsive buying. Know the warning signs when you start digging that hole. If you feel like you're getting too deep, track your expenses. Put down that Starbucks coffee and make your coffee. Make a plan to live within your means and stick to it. A lot of times we create a budget, we look at it 1 month, next month you say, oh, I don't feel like doing that. But we need to stick to it because we have goals and we have objectives. In order to get that way, we must stick to our plan. We want to have wisdom, we want to be able to invest, we want to save, and we want financial, economical freedom. Building wealth. Boy, that's important for us because why is our wealth gap this wide and everyone else's wealth gap is much narrower? Because you understand your credit score is one of the most important numbers in your life. That 3-digit number indicates your credit worthiness or the likelihood that you will repay the money that you borrow. Credit scores generally range from 300 to 850. So you don't want to be at that 300. You want to start getting into that 700. When you start getting into that 700, a lot of things and a lot of doors open up. The higher your credit score, the more likely it is that you will be approved for a new and better credit. 8 steps to building wealth. First step, you got to make a plan. And once you make a plan, you must stick to it. Make a budget. Build an emergency fund. You know, they always say it's good to have 3 to 6 months emergency fund, just in case something happens. Everybody know when COVID hit, a lot of people weren't prepared. You couldn't go to work because you couldn't go out. The business shut down. A lot of people didn't have an emergency fund, so they were trying to get emergency food vouchers, trying to find out how they can get the electricity paid, because we did not have an emergency fund. And we never know what life is going to hit. No one expected a pandemic to come and close down the world. Automate your financial life. And what that means is sometimes it's harder to pay a bill every month, but if you put it on there and your bill pay every month, it comes out. It comes out. So you don't have to worry about trying to write. Well, they don't do checks anymore anyway. You know, in my generation, we wrote more checks, but you just automate it. So it's automatically coming out of your account every month, and it helps you to manage your debt. And if any of you guys have a 401 or 403 or 457, you want to max out that retirement plan. Because guess what? If you're making a salary of $100,000 or $50,000 and you max that out, the average person that's under 50, you can defer at least $27,200 a year. And what that means is if your salary is $100,000, you subtract $27,000 off, and that's what you're going to be taxed on. So you can take that saving right there and start investing. That's why when you're in a company, max out your retirement savings. Don't say that you can't afford to do it. You cannot not afford to do it. Wouldn't you rather pay taxes if you're $100,000 and you can save at least $30,000 that's going to be deferred for the future? So you're paying taxes on $70,000. You don't want to give Uncle Sam that money right now. When you get older, hopefully your tax liability might not be as high. So you want to use those deferred saving plans that your company offer. So please, a lot of people won't even invest in, oh, they're not going to give me, they're not going to match it. It doesn't matter if they match it or not. You're not being taxed on that money right now. You want to stay diversified. You want to have different streams of income. You want to have different investments. and you want to up your earnings. That's why we say you want to max out your retirement plan so you can take those earnings and invest them someplace else. So you got to start someplace. But the main thing is starting is building your credit score. Build your credit score. Once you start building on that, guess what? A lot of things will open up to you, and it will help you start creating wealth. And what we need to do is create wealth, not for just now, for legacy and for generational wealth. We have to start building that. We want to have trust fund children too. You know, you always say, oh, they was a trust fund baby. Well, why can't our children be trust fund babies also? There is the Omega Psi Phi Fraternity Federal Credit Union symbol.
Logo and everything. But you said something really key, Constance, is why can't our children have trust funds as well? I don't think these are conversations we're having because many of us are just still in survival mode. But from what you walked us through today is that there's a plan, there's steps to get out. And if we stick to it, we don't have to be looking at our counterparts saying, oh, well, that's a trust fund, baby. We can say, well, my kid got a trust fund too. So you shared some really important nuggets for us to be thinking about. Anything else that you want to share?
No, I just think that we as a culture, we have so much wealth within our culture, and especially even with the Divine Nine, we have a lot of wealth there. And we have to learn how to maximize that. And we have to learn how to create a legacy and how to create generational wealth. And we don't have to make a lot of money to create wealth. We just got to be smart in investing.
Agreed. Very good. Very good. That is very helpful. So
Constance,
now, oh, go ahead.
I should say, Davina, it's Derek. I'm on my mobile phone, so hopefully I got a better connection this way. Before we go to you, I see your hand raised. Before we go to you, Emmett, I want to highlight, I did put it in the chat. Hopefully everyone saw it. She talked about evaluating your credit report a number of times. For those of you who are not aware, the credit union has a service with a company called Balance. And I put the website on there, and we encourage you to look on the website for a number of things that they have, information about webinars and other things. But most importantly, you can have your credit report reviewed at no cost to you with them. They'll walk you through it. They'll do a deep dive analysis of it and give you a written report on things that you can do to improve it. So please go on to Balance, oppfcu.balancepro.org and understand the mechanics of that. And they'll schedule an appointment with you so that you can have your credit report evaluated. And that will be for all three, the credit union organizations. Emmett, let me take you off of mute 1 second so you can ask your question. Okay. It's asking you to come off mute so you can speak. Emmett Orr.
Yes.
Go ahead.
Oh, there we go. We can hear you.
I
Oh,
see your hand.
yeah. Oh, okay. That was an accidental hand, but I do have a question because I wanted to know, and I was just going to call the credit union tomorrow. I wanted to know two things. One is if I could pay for next year's conclave if I can have money sent out of my account to do that. And then the second thing is I wanted to get some more details regarding trust funds for the children and grandchildren. And so I had planned to contact you. And
You want to take the question about the trust fund, and I'll address the other one.
okay, thank you.
If you want to get more information about estate planning and trust fund, Davina can drop you my card and number in there, and we can do a one-on-one and we can talk about that.
Okay, thank you.
Mm-hmm.
How to get this hand off?
No problem. We'll take it off for you.
Okay, thank you.
Yeah, contact us, and we will talk about how to have your funds transferred to pay for your conclave.
Yes, thank you. Thank you very much.
Davina, any more questions in the chat?
We just got a hand raised from Mr. Charlie Bruce himself.
Yeah, how you doing? Constance, thank you very much. I appreciate the flow and the energy you put into your presentation. One of the things you mentioned, opportunities for deferred income, let me refer to it in that way. And you mentioned 401k, and then you mentioned some other tools and avenues for deferred income that I'm not familiar with. If you could maybe spend a couple of minutes just expanding on those other routes for deferred income.
Right, you know, some companies, like I believe with the police force, like government job, they might have it's similar to a 401, but they call it a 457. And for you, like your teachers and public sector, they have like 403B, 401. Those are all deferred compensation plan, meaning that you haven't paid taxes on it. So it's deferred off of your income. So you're not being taxed on it now. You'll be taxed on it later when you get ready to retire. And you don't have to take that right now. The age is 73 when you have to really start taking it paying income on it, on those income, the taxes on it, because it's deferred to age 73. So that's why I was telling you that while you're still working, max out those. When you're over 50, you get to defer up to $30,000 a year without being taxed.
Okay, so if I understand correctly, those other
It
funds.
depends on what organization you work for.
Right,
What type
indeed. All right, very good.
and state.
Very good. Appreciate it then.
Oh, no problem. Thank you for asking.
We have another question being asked, do credit unions do any small business loans? Derek, you might want to try to answer that.
Sorry, I couldn't find the right mute button. Yes, we can discuss that in terms of what you're trying to achieve and the amount that you want. But yes, there's an opportunity there for you.
And I want to make sure everyone realizes Davina has put Constance Stewart's contact information in the chat for anybody who wants to follow up and contact her directly. It's in the chat.
But Davina, change that phone number to my cell phone number, because that's a office number which I don't answer because I use my cell phone.
Oh, okay. So let me add that in there right now, everyone.
Okay.
Come on, guys, because we got to get our credit together, because we spend more money than anybody out there. And why should we have the worst credit ratings? So we want to build that score up. And it's just little things that we think that don't help us, they do. Deferring that cup of coffee to just staying at home making your own coffee.
Yeah.
You know,
Well,
little things like that.
Constance, let me ask, you talked about the fact that when somebody does an inquiry on our credit, that has a typically negative effect on our credit score. Am I wrong in saying that sometimes that happens and we don't even know what's going on? I mean, for instance, like if you call up a dentist and trying to switch, can't that dentist do a credit check on you and you don't really know what even happened?
Well, to do a hard inquiry, those are the ones. Soft inquiries don't affect your credit score. But to do a hard inquiry, you have to get permission from you. They just can't go run your credit just to run it.
Okay.
Yeah.
Are there other questions?
There's a question being asked from Isaiah Venning. He's saying, what is the average interest rate for a loan? Can you unmute Isaiah Venning so he can expand on his question? Because I'm not sure if he's talking auto, home, small business, loan for life. I'm not sure what he's asking about. And I'd rather have him articulate that. Isaiah Venning, can you make him available?
Yes, I unmuted him. He should be able to speak.
Isaiah?
Yeah, can you hear me? I'll just ask you just the average interest rate for a loan on a credit card. So if I was to get a credit card from the credit union, what's the average interest rate for a loan on a particular credit card?
So currently, the credit cards that we have is branded for the credit union through a third party,
Okay.
and it is based upon there's a fixed fee. It's based upon the credit rate once they run your credit check to issue the card to you.
Okay.
So it vary.
I appreciate that. Thank you.
Mhm.
Okay. I don't
Others?
see,
Are there other questions?
I don't see any more. Let me, I'm looking for,
I'll just mention this in the meantime. So Constance gave us a great worksheet that I just added into the chat to kind of give you some guidance into that. Be wise and in helping to improve your credit score, thinking about budgeting and all that good stuff. So that you can find in the chat and you are free to download it. Thank you, Isaiah. No, I think that's it.
Excellent.
I'd like to ask a question to the credit union personnel. With the credit union, since you've been in establishment since 1986, have you found that our culture seems to have the lowest credit scores, and you have a lot of credit counseling to help them build those credit scores up?
I won't say the lowest. We actually have if I looked at a bell-shaped curve, we have a number of people who are on the high end that do very well, and they use the credit union as a mean of just supporting the credit union. We have others that are in need of services, and they really look to the credit union to help them to find funding. And then we have a large population of individuals who are established, and they are really just saying, hey, I put money in the credit union. I don't really need any loans. I may be past the point where I really want to borrow money because I've established myself in my career. So it runs the gamut of particular individuals. And what we're trying to do is expose people that there are other capabilities out there for you. And that's one reason why we're doing this wealth seminar, to explain some of the various dynamics of how you have credit, where you should be using your credit, and what's the benefit of monitoring it.
Okay, and I found out, because I've been in the financial industry for over 10 years now, I find that when I look at our counterparts, when it comes to financial wellness, they have financial advisors to guide them in that direction. And it's sort of like with the Black culture, when they thought that going to therapy was something that we didn't do. Well, I think that it's just kind of the same thing now, that when you go to the doctor, you want someone who's knowledgeable of helping you get better. So you need to have someone, when you need a financial doctor, to help you manage your money, to make sure you put it in the right direction and have it assigned correctly. So I think that when we get more in depth with utilizing those tools to help us to build wealth, it helps us along the path. It's like when you said, when they come to the credit union, you might counsel them on how to improve their credit rating. Well, when improving your credit rating is great, but once you get that money that you can have to start investing, you have to have some type of advisor to direct you in the right path to use it and to invest in. So I think it's very important for us to have financial advisors or financial planners so that we can create wealth.
Yes, that's a very valid point. Well, thank you all so much for attending. Thank you, Constance, for your well-presented information. We hope everyone was able to take something out of this and can use it in their personal situation. For those of you on the call, this webinar is recorded, and we will post it on the Omega Credit Union website once the recording finishes. And we'll send out a survey to you guys to solicit your feedback on what worked and what other opportunities are you interested in hearing. We do have one more wealth series coming up. That'll be done by Curtis Baylor, and that will occur next week at the same hour at 8 o'clock Eastern, 7 o'clock Central.
I want to thank you guys for giving me the opportunity to share this information, and I hope they helped in some way.
We
Excellent.
appreciate you, Constance.
Thank you.
Thanks, everyone.
Thank
We
you,
appreciate
Constance.
your participation.
Yeah.
Good night.
Good night. Thank you.
Yeah. Constance, I wanted you to know that in the background, I got in touch with one of your sister's line members. And so I know